Welcome to the Achievement Apex podcast, the podcast where I share my knowledge and experience on trading psychology, strategy, risk management, and everything else that you need to know to take your trading to the next level. I'm your host, Brendan Murphy, and without further ado, let's get ready to learn something new that you can use to improve your trading results. All right, what's going on, everybody? I hope you're having a good start to your trading week. Now, the topic of today's podcast is how much money can you make as a day trader? Now, before I get into the topic of the video, I'm going to start doing a short weekly trading review at the start of every podcast, just in the hopes of being more transparent and establishing credibility with you guys. So last week, markets have been pretty choppy with the action going on between Ukraine and Russia. At the most, markets were down like 7%, and then they sort of recovered a bit to the end. Now, I only made one trade last week just because it was so volatile. That trade was a winner for 0.47%. So that's my performance last week. Now, moving on to the topic of the podcast, how much money can you make as a day trader? The short answer is probably nothing, because only 2% or even less than 2% of day traders are consistently profitable long term. Now, this video is not about whether you're probably going to succeed as a trader. This is about if you take day trading seriously and you do the work that's required and you get yourself a strategy that will make money and you follow all of the rules and you do everything properly so that you can be one of those successful people, then how much money can you make as a day trader? And there is no one true answer, you will make this much money as a day trader. It's a multivariate thing. There's a lot of different variables that go into it that can affect your profit. So for example, if you take more risk, you have the possibility to make more money. But basically, I'm going to break down all of the variables and I'm going to give you examples of how these variables will impact your results so you can get a rough idea of how much you can expect to make. So the first variable is risk, and it's basically how much of your capital are you willing to risk. So let's say you start with $10,000. How much of that capital are you willing to risk if stuff goes pear-shaped? If you're willing to risk $2,000, that would be 20% maximum risk. And basically, the more you risk, the more potential you have to make money. The second variable is frequency of trades. So are you trading once every 2 days? Are you trading 3 times a day? Are you trading 10 times a day? Basically, the more trades you take, the more potential you have to make money. It's not guaranteed that more trades equals more money, because things like over trading exist and that can lead to negative returns. You got to balance it, but more trades has the potential to make more money. The third variable is the instrument you're trading, or more specifically, the volatility of the instrument. So for example, if you're trading an instrument that fluctuates like 1% day to day, that's pretty small moves. Your possibility for big profit is really low. And in the same way, your probability of having a big loss is also low. However, if you trade a market that's extremely volatile, such as the cryptocurrency market, then you definitely have potential for much bigger winners, but also much bigger losers. So those 3 variables will impact your percentage returns. In terms of real dollar returns, the thing that's going to impact that is your capital. Are you trading with $1,000? Are you trading with $10,000? Are you trading with $100,000? Are you trading with $1 million? Obviously, if you're trading with $1 million, you're going to make more money than if you're trading with $1,000. I'm pretty sure everyone knows that, so I'm not going to spend 5 hours explaining that in this podcast because that would be silly. So let's try to isolate these 3 variables, risk, frequency, and instrument, and explain more specifically how they're going to impact your return and maybe give some examples too. So the first one is risk. As we've said, more risk equals more profit. To give you an example of percentage capital, maximum risk, and what kind of returns you could see with that is basically if you're risking a maximum of 5% of your capital, that means if you're trading with $10,000, the maximum you're willing to lose is $500. If that's your maximum loss, your yearly return, you can expect it to be somewhere around 25 to 50% at the very best. This is if you have a really, really good strategy and you're risking 5%. If you increase your maximum risk to 25%, then returns of up to 100% or more per year are possible. Now, I'm not saying that more risk is better, because if you risk too much and that leads to emotional trading, then emotional trading can lead to bad trades, which leads to losses. So don't think that just more risk is better and that you should up the risk always because more money, good, because it's not always the case. In terms of frequency, theoretically, if you double your frequency of trading and all other variables stay the same, then you could double your rate of return. So for example, if you're taking like 1 trade per week and your yearly return is like 10%, then going to 5 trades per week and all other factors are the same, then you could be making 50% per week. And then third variable, volatility. If you have an instrument that fluctuates up and down 1% and you're making 5% per year, and then you switch to an instrument that fluctuates up and down 5% and all other variables are the same, then you might be able to make 50% per year. And the other thing to consider is that these variables impact each other. For example, if you increase volatility, you also happen to be increasing risk. It's not like you can just isolate one and increase it for guaranteed profits. It's not quite that simple. For example, increasing frequency could possibly increase risk as well. You have to try to factor these things in when you're deciding the rules of your strategy. How much risk do you want to take? How does that impact the frequency? How does that impact the volatility and the risk? It's like a cycle of affecting each other. So let's just assume that volatility is whatever it is, 2.5% per day, 1% per day, because it's kind of like a double-edged sword. It's similar to leverage. It's just more profit with potential for more loss. So let's focus on the trade frequency and the risk. So let's say we have one trade per day with 5% maximum risk. In that instance, you might be able to make 10 to 20% per year if you're really good. Now, what happens if we double that to 2 trades per day at 5% maximum risk? Then you might be able to make 20 to 40% because you doubled the frequency, everything else stayed the same. And if you sort of flip that and you make 1 trade per day, and this time you have 10% maximum risk, also you could be making 20 to 40% per year. And then lastly, if you had 2 trades per day and 10% maximum risk, then you could be making 40 to 80% per year. So in the first example, 1 trade per day, 5% maximum risk, that equaled 10 to 20%. If you double one of those variables, then you double the potential profit. You double the other one, then you double that potential profit again. By doubling your trades per day and your maximum risk, you 4x'd your possible return. So there are ways that you can use this formula to unreasonably increase your returns without maximally increasing your drawdown. So for example, you only doubled your risk, but you 4 times your return. So there are ways when you're making your strategy that you can make some really smart moves to increase profit without increasing risk by the same factor. So now let's move on to real life strategies that I've either made for my clients or for myself, and what kind of returns that they have. The most common sort of percentages that I see when I'm making a strategy is I like to see a maximum risk of about 5%. That's the number that I'm comfortable with, and that's the number that I find most of my clients are comfortable with. People often say that they're happy with 10%, 15%, 20, 25% risk, but in my experience, if we put those levels of risk on, they very quickly go, "Ooh, what's happening here? Is this going bad? Is it going wrong? Should we change it?" And they start getting emotional and doing bad trades because they really couldn't handle that risk that they thought they could. So I find 5% is really the number to aim for here. So I often have a strategy that makes between 1 to 2 trades per day. Sometimes it makes more, sometimes it makes less, but on average 1 to 2 trades per day. And I often see annual returns of around 50 to 70% per year. It can vary. Some strategies I make are up to 100. Some of them, I don't usually go below 50 because I want to do good, right? To me, it's like if I make a strategy and the return is only 40%, it's kind of like I'm doing a disservice to either me or to my clients. So if that's the case, I scrap it and I start again until I do actually get the returns that I want for them. So that's kind of the returns that I like to aim for. Now, I just want to remind you once again that more risk is not better. So don't go out there and start risking all of your money, because at that point you're gambling. You might as well buy a lotto ticket. I hope that clears up the question. How much can you make as a day trader? If you found the video helpful, please like the video, leave a comment, maybe something you want to hear in another episode of the podcast. Please subscribe to the channel because it helps me and keeps you notified of future episodes. Also, please share the video with a friend or someone else if you think they will benefit from this too. If you want to have some more in-depth trainings that are also free, by the way. So for example, you want to get a training on how to use the RSI for profit, how to use support and resistance, or how to incorporate moving averages or multiple moving averages to increase your profitability and your win percentage. All those can be found for free by joining my Facebook group. Link is in the description for that one. And lastly, if you want to get yourself a custom-made trading strategy designed specifically for you, for whatever instrument you want, whatever risk you want, whatever time you wake up and go to bed, we can make it specifically for you to get the maximum returns with the minimum risk. If that sounds like something you want, please click on the link in the description to go to my website and book your free strategy call with me. We'll go over your requirements and see if a strategy is a good fit for you. Thank you very much for watching, and I'll see you again in the next episode. Bye-bye.